All right, today we are diving into something called modern monetary theory, or MMT for short. And, this isn't just some new strategy for playing the economic game. MMT basically argues that we've been looking at the entire board completely wrong from the very beginning. So let me just start with a really big question, a provocative one. What if everything we think we know about government debt is just wrong? Like, what if the national debt isn't anything like your credit card bill? And what if the whole idea that a government needs to find the money to pay for things is just a total misunderstanding? I mean, that's the core challenge MMT throws down. So, what exactly is this thing, MMT? Well, to really get it, we first have to understand what it's pushing back against. And it's a direct challenge to the economic rules most of us just, take for granted. Okay, so at its absolute core, MMT says that a country that issues its own currency, think about the US with the dollar or Japan with the yen, well, it can't run out of that currency. It's kind of like a scorekeeper at a football game. Can they run out of points to give? Of course not. And if that's true, it means that government spending isn't actually limited by the money it brings in from taxes or borrowing. Now, this is a huge departure from the standard view, what's called neoclassical economics. You've heard this a million times. It's the government is like a household analogy, right? You and I, we have to earn money, or maybe borrow it, before we can spend it. And this traditional theory says, hey, the government is no different. And right here, you can see the fundamental split. It all comes down to this. Is the government a currency user, like you and me, or is it the currency issuer? Does it have to get the money before it can spend it, or does the very act of spending create the money? I'm telling you, this one single distinction, it changes absolutely everything. Okay, to really wrap our heads around MMT, we have to go way back to basics. We have to ask a really simple question. What even is money? And why do we all agree to accept it? The answer, it turns out, is a lot less straightforward than you probably think. So, the conventional story. You've probably heard this one. It starts with barter, right? You have chickens, I have wheat. It's super inefficient because what if I don't want your chickens? So eventually, we all agree on a middleman, something valuable like gold. And then, to make things even easier, we start trading paper that just represents a claim on that gold. This is the metalist view, the whole idea that money's value comes from the shiny metal locked away in a vault somewhere. But here's the twist. MMT comes along and says, nope, that whole story is completely backwards. And they point to evidence like ancient Mesopotamian clay tablets. It turns out those tablets weren't money. They were IOUs. They were records of debt. So credit and debt didn't come after money was invented. They came first. This leads to a really crucial idea in MMT called chartalism. And it goes like this. Money isn't valuable because it's backed by gold. It's valuable because the government says, hey, you owe us taxes and you can only pay us in this specific currency that we create. All of a sudden, everybody needs to get their hands on that currency to pay their taxes. So get this. From this point of view, taxes don't actually fund the government's spending. They create the demand for the government's money in the first place. The economist George Friedrich Knapp had this perfect analogy. He said, think of a dollar bill like a coach check ticket. The little piece of paper itself is worthless, right? But it's proof of a claim. It represents the government's IOU to you. And you can then take that IOU and use it to cancel out your IOU to the government, which is your tax bill. Once you've paid your tax, the ticket's job is done. It's settled. Okay, so if money is basically just a token of debt, how does it actually get created and start moving around the economy? Well, the way banks and the government actually get us into our hands is, surprise, surprise, probably not what you learned in Econ 101.
All right, the textbook version is called the money multiplier. And the story goes like this. You deposit $1,000 in the bank. The bank has to keep a little slice of that, say $100, in reserve. Then it loans out the other $900. That $900 gets deposited somewhere else, and the whole process repeats. The idea is that deposits create loans.
And you guessed it, just like with the origin of money, MMT argues this whole model is completely backwards. I mean, just think about it for a second. Have you ever heard of a bank telling a perfectly good borrower, sorry, we can't give you a mortgage today, we've run out of money to lend?
No, of course not.
The reality, MMT says, is that loans create deposits. When a bank approves your mortgage, it doesn't go to a vault and get the money. It just types new numbers into your account. Poof, that money is created in that exact moment. It's only after the loan is made that the bank has to worry about finding the legally required reserves to back it up, which, by the way, they can easily borrow from other banks or the central bank if they need to. Now, this very same logic applies to the government.
The conventional story is that the government has to get money from taxes or borrowing before it can spend. But MMT says no. The government, as the creator of the currencies, spends first. It just credits bank accounts, creating money out of thin air. So a government deficit, it isn't what we think it is. It's just the pile of money the government spent into the economy that it hasn't bothered to tax back out yet. Think about that. A government deficit is, by definition, the private sector's surplus.
Okay, I know what you're thinking. The second you say a government can just create money, two giant alarm bells start ringing in everyone's head. What about runaway inflation? And what about unemployment? So let's tackle those fears head on. So what causes inflation? Well, the classic answer is too much money chasing too few goods. MMT actually agrees with the too few goods part, but it really reframes the cause. It says inflation isn't really a money problem, it's a real resource problem. It happens when everyone, the government, businesses, you and me, are all trying to buy more stuff and services than our economy can physically produce. We run out of workers, we run out of factories, we run out of raw materials.
And this unemployment chart is really key to the MMT argument. Just look at it. The unemployment rate is almost never zero. For MMT folks, this is Exhibit A, that our economy almost always has slack. That is, people who want to work but can't find jobs, factories sitting idle. And they argue that as long as that slack exists, the government can increase its spending without causing that too much demand inflation, because it's just putting those unused resources to work.
But wait, what about those times we see inflation even when a lot of people are unemployed? Well, MMT explains this with something called conflict theory. This is inflation caused by a power struggle over who gets what piece of the economic pie. For example, a giant corporation with a monopoly might raise its prices just to boost profits, or a sudden global oil crisis could jack up energy costs for everybody. The problem there isn't that we're all spending too much, it's a power imbalance or a supply shock. And this completely changes how we should think about unemployment. The conventional view says there's a natural rate of unemployment, and if we try to go below it, we'll get inflation. MMT just rejects that idea completely. It says unemployment is always a policy failure. It's proof that the government isn't spending enough to activate the economy's full potential and give a job to everyone who wants one. So, if we take all of this on board, what does it actually mean for how we run the economy? What are the real-world implications? Well, it fundamentally shifts the entire conversation. Let's just recap the big takeaways here. 1, a government that issues its own currency can never go bankrupt in that currency, period. 2, taxes don't fund spending. They create a demand for the currency and can be used to cool down inflation. 3, government deficits create private sector financial savings. And 4, the real limit on spending isn't a dollar amount. It's inflation, which only happens when we run out of real things to buy. And this right here is the big paradigm shift. When we start talking about huge goals like a green energy transition or universal health care, the debate completely changes. The question is no longer, how do we pay for it? Instead, the MMT question becomes, do we have the real resources, the labor, the materials, the energy, to actually do it without causing inflation? And this leaves us with a really fascinating final thought. See, MMT doesn't say there are no limits. It just insists we've been staring at the wrong one this whole time. So if money isn't the real constraint on what we can achieve as a society, what is? And what could we actually accomplish if we started focusing on the real limits instead? That's the conversation MMT wants us to have.